Two people invest the same amount of money. One starts at 25, the other starts at 35. By retirement, the first person has nearly twice as much, despite investing the exact same total amount. How? The answer is compound interest, and once you understand it, you'll never look at saving the same way again. Welcome to Money Grows on Trees. Today, we're breaking down compound interest, the mechanism that turns small, consistent savings into life-changing wealth. We'll visualize exactly how it works, show you real numbers, and explain why starting early matters more than starting big. To understand compound interest, first, let's understand simple interest. Simple interest is calculated only on your original amount, your principal. If you invest $1,000 at 10% simple interest, you earn $100 every year. After 10 years, you have $2,000, your original $1,000 plus 10 years of $100 each. Compound interest is different. It's interest earned on your principal plus all the interest you've already accumulated. In other words, you earn interest on your interest. That same $1,000 at 10% compound interest. Year 1, you earn $100. Now you have $1,100. Year 2, you earn 10% of $1,100, which is $110. Now you have $1,210. Year 3, you earn 10% of that, $121, and so on. After 10 years, simple interest gives you $2,000. Compound interest gives you $2,594. That extra $594, that's the power of earning interest on your interest. The compound interest formula looks like this. A equals P times 1 plus R to the power of N. Don't worry, it's simpler than it looks. A is your final amount, what you end up with. P is your principal, what you start with. R is your annual interest rate, your return percentage, and N is the number of years. The magic is in that exponent, the N. Because N is in the exponent, every additional year doesn't just add to your total, it multiplies it. That's why time is the most powerful ingredient in investing. Not the amount of money, not even the interest rate. Time. Let's see this with real numbers. Imagine you invest $200 per month in a broad market index fund, and you earn an average of 7% per year, a commonly used long-term benchmark, though actual returns vary year to year. After 10 years, you've invested $24,000 of your own money. Your investment has grown to about $34,000. You've earned $10,000 in compound growth. After 20 years, you've invested $48,000. Your portfolio's worth about $98,000. That's $50,000 of pure growth, more than you even put in. After 30 years, you've invested $72,000. Your portfolio's worth about $243,000. Your money has more than tripled. After 40 years, you've invested $96,000. Your portfolio's worth about $528,000. Let that sink in. $96,000 of your own money becomes $528,000. The other $432,000, that's compound interest doing the heavy lifting while you sleep. Now here's the most important comparison in all of personal finance. Person A starts investing $200 per month at age 25. They invest for just 10 years, then stop completely. Total invested, $24,000. Person B waits until age 35 to start. They invest the same $200 per month, but they keep going for 30 years until age 65. Total invested, $72,000. At age 65, assuming the same illustrative 7% average annual return, person A, who invested only $24,000 but started early, has about $243,000. Person B, who invested 3 times as much money but started 10 years later, has about $243,000. They end up roughly equal, even though person B invested 3 times as much of their own money. Person A's 10-year head start was worth as much as 30 years of contributions. That's why the single most important thing you can do for your financial future is start now. Not when you make more money, not when the market looks good. Now.
Here's a quick mental math trick, the rule of 72. Divide 72 by your annual interest rate, and you get the approximate number of years it takes for your money to double. At 7%, 72 divided by 7 equals about 10.3 years. Your money doubles roughly every 10 years. At 10%, 72 divided by 10 equals 7.2 years. Your money doubles every 7 years. At 5%, 72 divided by 5 equals 14.4 years. This means if you're earning 7% and you have 30 years until retirement, your money will double approximately 3 times. $1,000 becomes $2,000, then $4,000, then $8,000 without adding another penny.
Compound interest is powerful, but 3 things can kill it. First, waiting. Every year you delay is a year of compounding you lose forever. The cost of waiting isn't just 1 year of returns. It's 1 year of returns on all the growth that would have followed. Starting 1 year earlier could mean tens of thousands of dollars more at retirement. Second, fees. A 1% annual fee doesn't sound like much, but over 30 years, it can eat up nearly 30% of your total returns. This is why low-cost index ETFs are so important. A 0.03% fee versus a 1% fee is the difference between hundreds of thousands of dollars over a lifetime. Third, withdrawing early. When you pull money out of your investments, you don't just lose that amount, you lose all the future compound growth it would have generated. A $10,000 withdrawal at age 30 isn't just $10,000. At 7% over 35 years, it's actually over $100,000 of lost future wealth. Here's how to put compound interest to work for you starting today. Step 1, start now. Even if it's $50 a month, time matters more than amount. Step 2, invest in low-cost index ETFs. Minimize fees to maximize compounding. Step 3, automate. Set up monthly transfers so you invest consistently without thinking about it. Step 4, reinvest all dividends. Don't take them as cash, let them compound. Step 5, don't touch it. Leave your investments alone for decades. The market will have ups and downs, but over long time periods, compound growth wins. Albert Einstein supposedly called compound interest the 8th wonder of the world. Whether he actually said that or not, the principle holds. Compound interest is the most powerful force in personal finance. The earlier you start, the harder it works for you. If this was helpful, subscribe to Money Grows on Trees for a new finance breakdown every week. In the next video, we're covering emergency funds, how much you really need, where to keep it, and why it's the foundation of every financial plan. Remember, this channel is for educational purposes only and is not financial advice. The return figures used in this video are illustrative and based on historical averages. Actual market returns vary, and past performance does not guarantee future results.